Hello and welcome to News Analysis, where we break down the latest news, trends, and global events in ways that matter to you. In today's fast-moving world, it can be hard to cut through the noise, and that's why we're here, to provide clear, insightful analysis and in-depth coverage of the stories that shape our lives. Today we break down the biggest headlines and dive deep into the stories that shape our world. I'm Michelle, and each week we'll take a closer look. U.S. economy added a whopping 254,000 jobs last month. The U.S. economy added a robust 254,000 jobs last month, surpassing expectations and signaling continued strength in the labor market. This job growth highlights resilience in key sectors such as healthcare, professional services, and hospitality, despite rising interest rates and persistent inflationary pressures. The unemployment rate remains low at 3.8%, indicating that many sectors continue to demand more workers. However, wage growth has moderated slightly, which could help ease inflationary concerns as businesses adjust to ongoing Federal Reserve interest rate hikes. The report reflects the broader trend of solid job creation and a stable economy, though concerns about the potential for a future slowdown persist. This latest employment data will likely factor into the Federal Reserve's future decisions on monetary policy, with analysts debating whether it will justify further rate hikes or signal the need for a pause. The steady increase in jobs offers a mixed bag for economic policymakers balancing growth with inflation control. The U.S. economy added an impressive 254,000 jobs in the past month, beating economists' forecasts and further showcasing the labor market's resilience amid a backdrop of economic challenges, including high inflation and rising interest rates. The unexpected job gains highlight the continued strength of key sectors such as healthcare, professional and business services, leisure, and hospitality. This growth reflects a strong demand for labor as the country continues its recovery from the pandemic-induced slowdown. Despite ongoing concerns about inflation, which remains higher than the Federal Reserve's target of 2%, the unemployment rate held steady at 3.8%. This figure represents a historically low level, indicating that the labor market is still tight, though not as much as during the height of the pandemic recovery. Even as employers continue to create new jobs, the pace of wage growth has moderated slightly, a potential sign that inflationary pressures from rising wages may be cooling. Average hourly earnings rose by 0.2% month over month, compared to the previous 0.3%, showing a slight easing in wage inflation in sectors like leisure and hospitality, which were hit hardest by the pandemic. Hiring has continued to accelerate as businesses recover and consumer demand remains strong. The healthcare sector also showed strong job creation, reflecting the ongoing need for workers in both public and private healthcare services as the nation grapples with aging populations and the long-term impacts of the COVID-19 pandemic. The Federal Reserve has been closely monitoring labor market data to guide its monetary policy. The strength of the job market, coupled with easing wage growth, presents a delicate balancing act for the federal policymakers are attempting to slow the economy just enough to bring down inflation without tipping it into a recession. With job growth continuing at this pace, there is now increased debate over whether the Fed will raise interest rates further in upcoming meetings or pause to assess the cumulative impact of its past rate hikes on inflation and economic activity. Some economists have raised concerns that the labor market's resilience could complicate the Federal Reserve's efforts to tame inflation. If strong job growth continues to drive consumer demand, it could keep inflationary pressures elevated, forcing the Fed to remain aggressive in its tightening cycle. However, others argue that the slowing pace of wage increases may suggest that inflationary pressures are already starting to ease, providing room for a more cautious approach to interest rate hikes moving forward. While the labor market is booming, other sectors of the economy show signs of softening. Manufacturing, for instance, has faced challenges due to weakened global demand, and the housing market continues to adjust to higher mortgage rates. The stock market has also reacted cautiously to the news, as investors weigh the potential for more interest rate hikes against signs of economic resilience. Overall, the latest jobs report paints a picture of a U.S. economy that remains strong, despite headwinds from inflation and higher interest rates. While some economists see this as a positive sign for growth, others warn that continued robust hiring could further complicate the Federal Reserve's efforts to achieve its inflation goals. The coming months will be crucial as policymakers navigate this complex economic landscape, with the possibility of more jobs reports like this one influencing the direction of monetary policy. The U.S. economy's addition of 254,000 jobs last month signals not only the resilience of the labor market, but also broader trends that reflect the ongoing complexities in economic recovery and policymaking. This surge in employment, which outpaced economists' expectations, indicates that businesses across key sectors are continuing to expand and hire despite the Federal Reserve's sustained interest rate hikes aimed at controlling inflation. The strong job growth adds momentum to the broader economy but raises critical questions about the path forward for inflation control, monetary policy, and long-term economic stability. Sectoral strength and labor demand. Several industries have been driving this impressive job creation. Healthcare, one of the fastest-growing sectors, has seen a consistent rise in demand for workers. The aging U.S. population, combined with the lasting impacts of the COVID-19 pandemic, has strained healthcare systems, leading to an increased need for professionals in hospitals, outpatient care, and long-term care facilities. In September alone, the healthcare sector added thousands of new positions, particularly for nurses, healthcare aides, and administrative staff. Leisure and hospitality also contributed significantly to the job gains. After being one of the hardest-hit sectors during the pandemic, it continues its strong recovery as restaurants, hotels, and entertainment venues ramp up hiring to meet pent-up consumer demand. The ongoing return of travel and tourism has particularly bolstered hiring in these areas, with businesses scrambling to fill roles to serve the influx of domestic and international tourists. Professional and business services have been another standout, reflecting the demand for specialized roles in technology, consulting, and management. Even with concerns about a potential economic slowdown, companies are still investing in skilled labor to drive productivity and digital transformation. Job creation in this sector suggests that businesses remain optimistic about future growth and are preparing for long-term expansion. Wage growth and inflation dynamics. While job growth has been a bright spot, wage growth has shown signs of cooling. Average hourly earnings increased by 0.2% in the latest report, down from a prior 0.3% rise. On a year-over-year basis, wage growth now sits at 4.1%, slower than earlier in the year. This moderation in wages could ease inflationary pressures, as rapid wage increases have been a key driver of rising prices in the service sector. However, inflation remains stubbornly high, even if it has come down from its peak. Core inflation, which strips out volatile food and energy prices, is still running above the Federal Reserve's 2% target. This means that while wage pressures are easing, prices for goods and services continue to rise, albeit at a slower rate. The Fed's key challenge is to strike a balance between cooling the economy enough to reduce inflation without stifling job creation and economic growth. Federal Reserve's dilemma. The latest jobs report will be carefully scrutinized by the Federal Reserve, which has already raised interest rates to a 22-year high. These rate hikes are intended to reduce inflation by slowing down consumer spending and borrowing, but the continued strength of the labor market complicates the Fed's task. Typically, higher interest rates lead to slower job growth as businesses face higher borrowing costs and consumers reduce spending. However, the resilience of the labor market suggests that companies are still eager to hire, indicating that the economy remains robust despite tighter financial conditions. This persistent job growth puts the Fed in a challenging position. On one hand, continued robust hiring could keep demand high and make it harder for inflation to fall, suggesting that further rate hikes might be necessary. On the other hand, the signs of wage moderation and slower inflation could prompt the Fed to consider pausing its aggressive rate increases to avoid over-tightening the economy and triggering a recession. Jerome Powell, the Federal Reserve Chair, has signaled that the central bank will continue to be data-dependent, closely watching economic indicators like jobs and inflation before making any decisions about future rate hikes. Some analysts believe that the Fed could pause rate hikes to assess the lagging effects of previous increases, while others warn that if inflation proves more stubborn, additional hikes may be on the table. Broader economic implications. The positive jobs data reflects an economy that remains fundamentally strong, but it also underscores growing sectoral imbalances. While industries like healthcare, hospitality, and professional services thrive, other areas, such as manufacturing and real estate, have seen notable slowdowns. Manufacturing has been impacted by slowing global demand, supply chain disruptions, and higher production costs, leading to more cautious hiring. Meanwhile, the housing market continues to struggle under the weight of higher mortgage rates, which have dampened home buying activity and slowed residential construction. Consumer confidence remains relatively high, buoyed by low unemployment and steady wage growth, but cracks are starting to appear. Rising interest rates are increasing the cost of borrowing for consumers, making big-ticket purchases like homes and cars more expensive. Additionally, persistent inflation is eroding purchasing power, particularly for low- and middle-income households, even as wages rise. The stock market has been volatile in response to the jobs data, reflecting investor uncertainty over the potential for further interest rate hikes. While a strong labor market is generally seen as a positive sign for corporate earnings and consumer spending, investors are wary of the Fed's next moves and the potential for higher rates to curb economic growth in the long term. Looking ahead, the 254,000 jobs added last month showcase the U.S. economy's continued recovery and resilience, but they also bring into focus the complexities of the current economic landscape. With inflation still elevated and interest rates at their highest levels in decades, the economy is at a crossroads. The Federal Reserve's future actions will be critical in determining whether the economy can sustain its current momentum without overheating or whether a slowdown, or even a recession, might be looming on the horizon. Policymakers, businesses, and consumers alike will be watching closely as the Fed navigates this delicate balance between growth and inflation control. The next few months will be pivotal, with future jobs reports and inflation data playing a key role in shaping the trajectory of the U.S. economy heading into 2024. Please subscribe, like, share, comment, and support News Analysis channel. Your one step towards News Analysis channel will help us to support my family.